Verizon Communications trades at approximately $49 per share for a market value of $202 billion. At that price, our reverse DCF implies approximately 5.3% annual unlevered free cash flow decline for the next 10 years. That price-implied path takes estimated unlevered free cash flow from $26 billion today to $15 billion in year 10, 0.6 times the current level. Over fiscal 2022 to 2025, reported free cash flow grew by 23.7% per year. That is the delivered record beside the price-implied 5.3% annual decline path. Is this low-modeled hurdle justified, or are important risks missing? To answer that, we run the valuation through three lenses. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. And a price-to-earnings multiple adds context from comparable historical and market anchors when those are available. Three lenses, one conditional verdict. We model Verizon Communications' cash engine as subscribers to ARPU to network margin to free cash flow. The template's proposed defense is the network itself and the spectrum under it. A rival cannot serve a customer it has no coverage for, and coverage takes years and billions to reproduce. For an upside case to hold, four things must be supported: subscriber growth, ARPU discipline, network capacity, and return on capital. We will test each one later. Before the valuation, the track record. What has Verizon Communications actually delivered? Over the last 3 years, revenue grew approximately 0.3% a year, earnings per share declined approximately 7.1% a year, and reported free cash flow grew approximately 23.7% a year. Reported free cash flow margin moved from 7.6% in fiscal 2022 to approximately 14.5% for the latest trailing period. In the quarter ending June 2026, revenue fell 0.7% year over year, broadly in line with its recent trend. The question is whether that continues. Verizon Communications earns about its cost of capital and little more. Our normalized return on invested capital estimate is roughly 8% against a discount rate of 6%. You can see it on the chart. The stock has lagged the broader market over this period. That relative weakness is useful context for the valuation. But recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered. It is what the price now requires. At the time of this analysis, Verizon Communications trades at approximately $49 per share for an equity value of roughly $202 billion. Estimated trailing unlevered free cash flow is approximately $26 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It takes today's value and solves for the growth rate that makes the price possible. We use a discount rate of 6%, the company's estimated cost of capital, terminal growth of 2.5%, and the company's estimated unlevered free cash flow base. One adjustment first. Verizon Communications carries net debt of about $187 billion, so we solve against enterprise value rather than the headline market cap. The result: on these assumptions, today's price implies an annual unlevered free cash flow decline of approximately 5.3% over the next 10 years. And that conclusion is not fragile. Across reasonable discount rate and terminal growth assumptions, the price still implies a decline. That path takes unlevered free cash flow from $26 billion today down to approximately $15 billion in year 10, 0.6 times the current level. Watch it fade, year by year. Year 1 comes in around $24 billion. By year 5, approximately $19 billion. And by year 10, $15 billion, each year a little lower than the last. Under a constant margin translation, holding the current estimated unlevered free cash flow margin at 12.8% maps the modeled path to approximately $116 billion in annual revenue by year 10. That is a model result, not a claim that the price is justified. The market is not pricing in a collapse. It is pricing in 10 years of slow decline. The bar is low, and it stays low. But does our own forecast produce the same value? Now I forecast the business itself, $139 billion of trailing revenue, and how much of it turns into unlevered free cash flow. The base path starts at 1.1% and recovers only to 3%. That is trailing revenue growth blended with forward analyst consensus. Cash conversion gives back a lot of ground in this path, from 18.4% of revenue today down toward 12.8%. With a 6% discount rate and 2.5% terminal growth, that produces $82 per share. That discount rate is a market value weighted average cost of capital built from a 4.7% risk-free rate, beta of 0.5, 4.5% equity risk premium, and 3.9% pre-tax debt cost. About 67.4% of modeled enterprise value comes from the terminal value, so the result remains sensitive to long-run assumptions. The bear case starts at 0.8% growth and assumes cash conversion never improves at all, holding at 11.8%. It is worth $71. The bull case starts at 1.4% and reaches 14.2%, the best margin it has ever posted. It reaches $96. The width of that range is not our opinion. It is the spread between the highest and lowest analyst revenue estimate, and here they are, unusually close together. At $49, the stock sits below even our bear case. The DCF gives us a value. The multiple tells us what investors are paying for it right now. Our final lens is the valuation multiple. Verizon Communications trades at approximately 12.5 times trailing earnings. Based on expected forward earnings, that falls to approximately 9.2 times. The gap reflects the growth analysts already expect. The company's own median across 4 fiscal observations is approximately 9.1 times. The broader market trades at approximately 24 times on a configured trailing price to earnings benchmark. A high multiple is not automatic evidence of overvaluation. The question is whether earnings can grow fast enough to justify it, and that is exactly what the DCF already measured. The valuation survives mathematically, but only if a few conditions keep holding. Now the evidence. Subscriber growth is at risk. Revenue grew minus 0.7%, but the data does not isolate subscriber growth. ARPU discipline is mixed. Revenue growth of minus 0.7% and reported free cash flow margin of 14.5% do not isolate pricing. Network capacity is mixed. CapEx at 12.6% of revenue falling. Return on capital is mixed. Return on capital of roughly 8% against a 6% cost of capital. None of 4 are supported. Subscriber growth, ARPU discipline, network capacity, return on capital remain unresolved. The verdict remains conditional. Now stress the model. The business risks are subscriber saturation, price competition, spectrum and network reinvestment. The screen translates them into exact valuation inputs. First, cut starting revenue growth to 70% of the base assumption. Fair value falls to $80. Second, reduce the steady-state free cash flow margin by 20%. Fair value becomes $62. Third, raise the discount rate from 6% to 7%. Fair value becomes $55. Finally, combine all 3 while fading mature growth to the terminal rate. The model falls to $37. These are standardized model stresses, not predictions. They show which assumptions the valuation is most exposed to. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. The standardized stresses show how the valuation moves. But before the verdict, there is one counter-argument this analysis owes you. The price is not asking this business to grow its cash flow, so there is no funding question to answer. The question is whether the decline it prices in is the right one. That is the last piece of evidence. So what do all 3 lenses say together? 3 lenses. Here is the verdict. Lens 1, the reverse DCF. The price only asks for free cash flow to fade 5.3% a year over 10 years, a lower implied free cash flow path than the company's recent delivery, but not a guaranteed outcome. Lens 2, our own DCF, $71 in the bear case, $82 in the base case, $96 in the bull case, and the current price sits below even our bear case. Lens 3, the multiple. A premium on trailing earnings, but roughly in line with its own median across 4 fiscal observations once you account for the growth analysts already expect. The combined downside case lands at $37, approximately 23% below the current price. Add the 3 together and something unusual appears. The price sits below even our cautious scenario, roughly 69.5% upside to our base case. Either our assumptions are too generous, or the market is pricing risks the model does not capture. The gap is a result to investigate, not proof of an opportunity. So what would justify today's $49? Free cash flow would have to follow the 5.3% annual decline the reverse DCF backed out, while our forecast points the other way. That distance is the expectation gap. The returns Verizon Communications earns on capital are thin on our estimate, which is part of why the price sits where it does. Our overall verdict, below our modeled bear case. Business quality and investment value are different questions. This conclusion remains conditional on the evidence and assumptions shown. That is the analysis. Thank you for watching. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research. Snapshot August 19, 2026. Position not disclosed. The description lists sources, method, and AI use.